Hello folks, Doc White here, ready to talk to you about the second module for the semester. This is going to cover Chapter 2 in the e-text, and it's called Measuring Your Financial Health. I'm probably going to break this module into 3 different videos just to keep them a little bit shorter, help you pay attention a little bit better. We'll work through some examples, so you might want to have a calculator handy for some of these videos. In measuring your financial health, we're trying to figure out what is your current condition. Remember when we talked about the financial planning process, step 1 is figure out where you are today? Well, that's what we're talking about. In order to do this, we're going to use some financial tools called a balance sheet, an income statement, which I'll probably refer to it more as a budget throughout most of the semester, but you'll also hear it called an income and expense statement, or in the business world, it's called a P&L, which stands for profit and loss. You'll get a little frustrated this semester because in the finance world, we use 3 or 4 terms for the same principle or for the same concept. I'm just going to warn you right now. We're also going to use some financial ratios that we use to measure your current financial condition. We're going to compare those ratios to typical benchmarks we use throughout the industry to identify what some of your financial strengths and weaknesses are. We'll talk briefly about record keeping and budgeting, and then we'll end up talking a little bit about the financial planning industry, how planners charge, what they do, and so on. I hope to have several financial planners do some videos or do some Zoom settings for you so you can learn more about that profession if you're looking for a career. Okay, let's start talking about a balance sheet. Those of you who have had an accounting course in the past, you might want to forget an awful lot of the principles that you learned, because in the real world, when we're dealing with personal finance, people just don't have very good records. We're taking some ballpark estimates. We don't follow the generally accepted accounting principles, the GAAP principles that you're taught. What we do is just try and get the best information we can from the client. A balance sheet is a financial statement that lists all of the things that you own and the value of those things, and it lists how you've paid for them up to this point in time. So it's a list of all the stuff you own and how you've paid for it. Another way to look at it, it's a list of what you own and what you owe on a given day. Not what you will owe over the next 12 months, but what you owe as of today. If you were to pay everything off as of today, how much would you owe? I'm going to use some terms here. We're going to use the term assets. Assets are things that you own. One of the main financial assets you have is your checking account, your savings account. You have retirement investments, you have stocks, bonds, mutual funds, you have a car, you have a house, you have a computer and a phone. All of these things are assets. And what we're going to do is list these things on the balance sheet, and we're going to list them at the fair market value. That's what you could expect if you were to try and sell these things online and get what they're worth, not just try and get cash real quick. So assets are things that you own. We'll go over some examples here in a bit. Liabilities, these are your debts. You might also hear it referred to as credit. This is money you owe to someone else. This will be credit cards, auto loans, student loans, home mortgages, those types of things. And then we'll use a term called net worth, or we also hear it called equity. Net worth is the measure of your financial value. And it's very simple to calculate. We're going to take the value of all your assets, and we're going to subtract off the value of all of your liabilities, and this is going to give you your net worth. So if you think about it, all of the things that you own, the value of all your assets, is going to be equal to the money that you have invested personally, your net worth, and the money that you have borrowed from someone else, the liabilities. So your net worth is your financial value on that day. We calculate this by taking the value of your total assets and subtracting off the value of all your liabilities. So net worth, or you also hear it referred to as equity, is a measure of how much you have paid for yourself over time. So remember, there's 2 ways to pay for things: your money, which we call net worth or equity, and someone else's money that we call liabilities. Together, these things add up to equal the value of your assets. Here's an example of what a balance sheet looks like. Again, it's a different format than you've seen in your accounting classes, but the key principles here: at the top, we're going to put your name on it, and we're always going to put a date. This thing is as of one day out of the year, and we commonly try to do these around January 1st. But on the left-hand side, we'll see all of our assets listed, and we'll break them up by categories. On the right-hand side, you'll see the liabilities, and we'll talk about what these categories are. Down at the bottom of the balance sheet, you'll see the value of your total assets, and you'll see the value of your total liabilities and net worth. These two numbers will always be equal to each other. That's why we call it a balance sheet. Your assets are balanced by how you've paid for them, equity versus someone else's money. The classifications we tend to use in the financial planning arena are different from what you see in your accounting classes, where they use current, intermediate, and long-term assets. In personal finance, we use monetary assets. This is going to be your liquid accounts, okay? Your cash on hand, your checking account, your savings account, your CDs, these types of assets. We're going to have your investment assets, and I like to break these into non-retirement and retirement. Very simple to figure out which is which here. If an account is strictly for a retirement, it's going to go into the retirement investment category. If the money can be used for anything, not necessarily retirement, it goes in the non-retirement category. And then the last category we use is called tangible assets, and these are the things that you own and you use in day-to-day life. So this would be your computer, your phone, your car, your clothing, your furniture, and those types of things. So here's some examples. Your monetary assets, again, these are things that are cash now or can be turned to cash very quickly without paying a lot of penalties or losing too much value. So it's going to be cash, the value of what you have in your checking account and your savings account. CDs, a CD is a certificate of deposit. We'll talk about that in Chapter 5. MMAs, this is a money market account. This is very similar to a savings account. And then if you have any emergency funds parked somewhere else, we're going to include those things as monetary assets. Under the investment assets for non-retirement, these will be the value of your stocks, bonds, mutual funds, any real estate that you might own. And again, these are not specifically for retirement. They are not in a retirement account. The book also lists cash value of life insurance as an investment asset. Some folks will list that as a monetary asset. To be honest, I don't worry too much. As long as you have it under the asset side of the balance sheet, you're in good shape. And then you see annuities. Annuities are life insurance products that are, again, they may be used for retirement, but they're not always. So they can be listed as non-retirement investments. For your retirement investments, let's keep it simple this semester. If it is in a retirement account, such as a Roth IRA, a traditional IRA, a 401k or a similar type plan like a 403b or 457, or if it's in a company pension or corporate pension, we're going to list that value as a retirement asset. And we'll talk about all those when we get to Module 9. Housing. This is where we're going to list the value of your house. If you are renting an apartment, you do not list the value of the apartment because you don't own it. We're only going to list the value of any residences that we own or any investment properties that we may own. For automobiles, we're going to list those as tangible assets as well. Why? We use these to get back and forth to school or get back and forth to work or just to go play around. So the value of your cars, your trucks, and so on are going to be listed as tangible assets in most cases. Your personal property, these are any collections you might have, your clothing, your household furnishings, your appliances that you own will be listed as tangible assets as well. And then we got other assets out there. Anything else that you own should be listed on the asset side of the balance sheet. If you do not own it, it does not go on your balance sheet. For example, if mom and dad own your car and you're doing your balance sheet, you do not list the value of that car because you do not own it. Another thing you might list on your balance sheet is the value of any businesses that you own or you invest in. Maybe you have a lawn mowing business in the summertime or a babysitting business or something like that. If that's a formal business and it has value, you can list your share of that value on your balance sheet. And then we can list any money that's owed to you. If you lent some money to someone, they should be paying you back. This is your money, So this will be any money that you have lent to someone else will be listed as an asset on your balance sheet. For the other side, the liabilities section, here's where we're going to list what you owe someone as of today. Okay? Not what you will owe them over the next month or two or over the next year, but what you owe as of today. Way to look at this is if you were to get out of debt, pay off all of the money you owe to someone on that day, what would it take? How much money would it take to do that? We're going to break these into two different sections. We call them current liabilities and long-term, or we might hear referred to as non-current liabilities. Current liabilities are things that you owe but are supposed to be paid within the next year. So this is money you owe someone as of today, but you haven't paid it yet. You will pay it within the next year. Examples of this would be your utility bills. If you have received your electric bill for, say, it's $100 and you don't owe this till September 15th, this is money you owe the power company as of today, so you'd list $100 as your utility bills payable. You're not going to list what your utility bill is going to be for the remaining months in the year because you can always cancel your account and not have to pay them anything. So it's what you owe, what you have been billed for as of today. It's not what you will be billed for over the next year. So examples here, your utilities, so your phone bill, your power bill, your water bill, and so on. Taxes, property taxes that you owe because you own property or you own a car. When you receive the bill for that, we'll list that as taxes payable. If you've received a bill from your insurance company and you have not paid it yet, that would be listed as a payable as well. Another thing we're going to list as current liabilities is your credit card balances. And what we do is look on your statement as of that date, say January 1st, how much you owe the credit card company as of January 1st. So if you were to pay them off in full, how much would it take? That's the value you're going to list on the current liability section for your credit card balances. For your long-term or non-current liabilities, here's where we're going to list the amount you have borrowed that is supposed to be paid back, but not within the next year. This might be over the next 5 years, 10 years, 30 years, whatever it happens to be. So this is where we're going to list the value of the auto loan that you still owe the bank. Or a mortgage. This is a loan you get to purchase a house. We're going to list the value we owe the bank for that mortgage. If you got a consumer loan to buy a big screen TV or take a vacation, we're going to list the amount we owe the bank as of that day. And then for your student loans, this is how much you still owe the loan company as of that day. Okay, we're not projecting out into the future. We're not taking into account that we're going to be borrowing more next semester. We're going to list the value you owe as of the day of the balance sheet. So if we take the assets and we subtract off the liabilities, that's going to give us our net worth. This is a value of what your worth is or what your wealth is in terms of dollars. And what we'd like to see is this thing increasing over time. Right now, for most of you, it's probably negative. Don't worry, that's very typical for students because student loans. Think about this. You borrowed money for a student loan to get your education, but we don't list the value of your education on the balance sheet. So it's probably going to be negative for most of you right now. Don't worry, it'll turn around quick enough. But what we want to do is we want to see this thing become positive, and we want to see it growing year after year until you hit your retirement years. And at that point, that's probably going to start to drop off or fall a little bit. Net worth is a measure of your financial wealth or your financial worth as of that day. What I tell you to do, let's try and track this thing every year. So January 1st of every year, let's do a balance sheet. What you want to see is your balance sheet's net worth increasing every year until you retire. And hopefully it'll keep increasing at that point too. But here's something I want you to understand. Net worth is not a measure of your self-worth or the value of you as a person. Guess what? I know a lot of folks who don't have a lot of money, but they're some of the nicest, best people on the face of the earth. I know some people who have an awful lot of money, and they may not be the nicest people around. So their net worth has no relation to your self-worth. You've got to look at yourself in the mirror every morning. So live life in a good, positive way. Be a good, kind person. Be a good citizen in the community. But this has nothing to do with your net worth. Your net worth doesn't tell you how good you are as a person, but what we want to do is see that this thing growing over time, okay? Do not compare your net worth to someone else because they're in a completely different situation. Let's look at two different people. One has a net worth of $50,000 and one has a net worth of $500,000. We can't look at them and say which one is better off or who's in better shape because what if I give you a little bit more information? What if the person with $50,000 in net worth has zero debt? They don't owe anyone a thing. But what about the person with $500,000 net worth? What if I told you they had $3.5 million in liabilities that they owed someone else? They are in a much riskier situation. So don't compare your net worth to someone else. Only look at your net worth, and we want to see this thing positive, and we want to see it growing year after year until you hit your retirement years. Again, as students, it's probably going to be negative. Don't worry, that's to be expected.